The United States, often seen as the land of opportunity and prosperity, has a darker side to its economic story. A staggering $1 trillion credit card debt looms over the nation, casting a shadow on the financial well-being of millions of Americans. In this episode, we will delve deep into the factors and circumstances that led to this alarming accumulation of credit card debt. From changing consumer behaviors to economic downturns, legislative policies to financial illiteracy, we will explore the complex web of reasons behind this crisis. Understanding the basics. Before diving into the intricacies of America's credit card debt crisis, it's essential to grasp the fundamentals. Credit card debt is essentially money borrowed from credit card companies that you are required to pay back with interest. The interest rates on credit cards tend to be significantly higher than other forms of debt, making it a costly way to borrow money. When credit card balances aren't paid in full each month, they accumulate, leading to the alarming levels of debt we see today. Consumer behavior. One of the primary drivers behind America's credit card debt crisis is consumer behavior. Over the past few decades, there has been a significant shift in how people use credit cards. In the mid-20th century, credit cards were primarily used for emergencies and significant purchases. Today, they are often used for everyday expenses like groceries, dining out, and entertainment. The convenience of plastic payments has led to a disconnect between spending and the tangible exchange of cash, making it easier for consumers to overspend. The allure of rewards programs and cashback offers has also incentivized credit card use. While these rewards can be lucrative, they often lead to overspending and a lack of budget discipline. Economic downturns. The financial landscape in the United States has been marred by several economic downturns over the past few decades. The Great Recession of 2008, for instance, resulted in widespread job loss and a decrease in household incomes. During such periods, many Americans relied on credit cards to make ends meet, further exacerbating their debt burdens. Moreover, economic downturns can lead to increased interest rates on existing credit card balances, pushing people further into debt. The compounding effect of high interest rates on outstanding debt can be devastating for individuals and families struggling to recover from financial setbacks. Credit card industry practices. The credit card industry itself plays a significant role in the accumulation of debt. Credit card companies often employ aggressive marketing tactics to lure in new customers, offering enticing promotions and low introductory interest rates. However, these promotional offers can be misleading, as they often lead to higher interest rates once the promotional period expires. Additionally, credit card companies have been known to engage in practices such as universal default, where they raise a customer's interest rate based on late payments to other creditors. These practices make it even more challenging for consumers to manage their credit card debt effectively. Legislative policies. Government policies and regulations also play a part in the credit card debt crisis. The Credit Card Accountability, Responsibility and Disclosure (CARD) Act of 2009 brought some much-needed reforms to the industry, such as limiting certain fees and providing clearer disclosure of terms. However, the law did not cap interest rates, leaving room for credit card companies to continue charging high rates. Furthermore, bankruptcy laws in the United States underwent significant changes in the early 2000s, making it more challenging for individuals to discharge credit card debt through bankruptcy. These legislative changes have left many Americans trapped in a cycle of debt with limited options for relief. Financial illiteracy. A lack of financial education and literacy is a pervasive issue in the United States. Many individuals do not fully understand how credit cards work, including the concept of compound interest. This lack of knowledge can lead to poor financial decisions, such as carrying a balance on a high-interest credit card. Financial literacy programs are crucial in empowering individuals to make informed decisions about their finances and credit card use. Unfortunately, such programs are not widely accessible, leaving many Americans vulnerable to debt accumulation. The role of advertising and peer pressure. Advertising and peer pressure also contribute to America's credit card debt crisis. The constant bombardment of advertisements promoting luxurious lifestyles and the use of credit to achieve them can influence consumer behavior. Moreover, societal pressure to keep up with peers in terms of material possessions can lead people to overspend and rely on credit cards to fund their lifestyles. Personal stories. Behind every statistic, there are personal stories of individuals and families grappling with credit card debt. Hearing these stories can shed light on the human toll of the crisis and the urgent need for solutions. Stories of people struggling to pay off medical bills, student loans, and daily expenses while juggling high-interest credit card debt highlight the widespread impact of this issue. Solutions and strategies. Addressing America's $1 trillion credit card debt crisis requires a multi-pronged approach. Here are some strategies that can help individuals and policymakers mitigate the problem. Financial education. Increasing financial literacy through school curricula, workshops, and online resources can empower individuals to make informed financial decisions. Regulation. Advocating for stricter regulations on credit card companies, including caps on interest rates and more transparent terms, can protect consumers from predatory practices. Budgeting and financial planning. Encouraging responsible budgeting and financial planning can help individuals avoid overspending and accumulating debt. Debt repayment plans. Offering debt consolidation programs and counseling services can assist individuals in managing and reducing their credit card debt. Savings initiatives. Promoting savings programs and emergency funds can provide a safety net for unexpected expenses, reducing reliance on credit cards. Consumer advocacy. Supporting organizations that advocate for consumer rights can help hold credit card companies accountable for their practices. America's $1 trillion credit card debt crisis is a complex issue with multiple contributing factors, including consumer behavior, economic downturns, industry practices, legislative policies, financial illiteracy, and societal pressures. Addressing this crisis requires a collective effort from individuals, policymakers, and financial institutions. By increasing financial education, advocating for fair regulations, and promoting responsible financial behavior, we can work towards reducing the burden of credit card debt on millions of Americans. It's crucial to remember that behind the statistics are real people struggling to achieve financial stability and security, and our efforts should be aimed at improving their lives. Additionally, it's essential to encourage a shift in societal attitudes towards credit card use and consumerism. While credit cards can be valuable financial tools when used responsibly, they should not be seen as a means to accumulate debt to fund a lifestyle beyond one's means. Individuals can take several steps to manage their credit card debt effectively. Create a budget. Establish a realistic budget that outlines your monthly income and expenses. Allocate a portion of your income to debt repayment and stick to your budget rigorously. Pay more than the minimum. Paying only the minimum required payment on your credit card balance can lead to a never-ending cycle of debt. Aim to pay as much as you can above the minimum to reduce your debt faster. Prioritize high-interest debts. If you have multiple credit cards with varying interest rates, prioritize paying off the one with the highest interest rate first. This approach, known as the debt avalanche method, can save you money on interest. Consider debt consolidation. Debt consolidation involves taking out a new loan at a lower interest rate to pay off your existing credit card debt. It can make managing your debt more manageable and cost-effective. Seek professional help. If you're overwhelmed by your credit card debt, consider contacting a credit counseling agency. These organizations can provide guidance, negotiate with creditors on your behalf, and help you establish a debt management plan. Limit credit card use. Temporarily reducing or eliminating your credit card usage can prevent further debt accumulation. If you must use your cards, do so responsibly and avoid carrying a balance. Emergency fund. Establish an emergency fund to cover unexpected expenses, reducing the need to rely on credit cards in times of crisis. Monitor your credit. Regularly check your credit report for errors and discrepancies. A good credit score can provide access to better financial products and lower interest rates. Financial counseling. Consider seeking advice from a financial counselor or advisor who can help you create a long-term financial plan and set achievable goals. For policymakers and regulators, addressing the credit card debt crisis requires a commitment to consumer protection. Legislation should focus on capping interest rates, eliminating predatory practices, and increasing transparency in credit card agreements. Furthermore, schools and educational institutions should integrate financial literacy programs into their curricula to prepare the next generation for responsible financial management. America's $1 trillion credit card debt crisis is a multifaceted issue with far-reaching consequences for individuals, families, and the economy as a whole. Understanding the root causes, from changing consumer behaviors to legislative policies and financial illiteracy, is crucial in developing effective solutions. While there is no one-size-fits-all approach to resolving this crisis, a combination of financial education, regulatory changes, responsible borrowing, and support systems can help individuals take control of their financial lives and reduce their reliance on high-interest credit card debt. By working together as a society, we can move towards a future where the burden of credit card debt is significantly reduced, and financial well-being becomes more attainable for all. Moreover, It's important for financial institutions to play a role in addressing the credit card debt crisis by adopting responsible lending practices. Here are some steps that financial institutions can take to help mitigate the issue. Responsible credit card issuance. Financial institutions should assess an applicant's ability to repay before approving credit card applications. This can help prevent individuals from being approved for credit cards they cannot afford. Transparent terms and conditions. Make credit card terms and conditions clear and easy to understand. Avoid hidden fees or terms that could confuse consumers. Lower interest rates. Consider offering credit cards with lower interest rates, especially to customers with good credit histories. Reducing interest rates can make it easier for customers to manage their debt. Financial literacy programs. Financial institutions can take the initiative to educate their customers about responsible credit card use. Providing resources, workshops, or online materials on financial literacy can empower consumers to make informed decisions. Financial counseling services. Offer access to financial counseling services for customers who are struggling with credit card debt. These services can provide guidance on debt management and budgeting. Credit card debt repayment plans. Financial institutions can collaborate with customers to create personalized debt repayment plans. These plans may involve lowering interest rates, extending payment terms, or waiving fees for customers in financial distress. Savings and investment products. Promote savings and investment products that encourage customers to build financial security. Encouraging savings can reduce reliance on credit cards during emergencies. Credit limit reviews. Regularly review and adjust credit limits based on the financial situation of cardholders. This can help prevent individuals from accumulating excessive debt. Credit counseling partnerships. Partner with credit counseling agencies to provide customers with additional support and resources for managing their credit card debt. Social responsibility. Financial institutions can also contribute to social responsibility by supporting initiatives aimed at promoting financial literacy and addressing debt-related issues in communities. It's important to note that addressing the credit card debt crisis requires a collaborative effort between individuals, policymakers, financial institutions, and educational institutions. By working together to promote responsible credit card use, improve financial literacy, and implement regulatory reforms, we can make significant progress in reducing the burden of credit card debt in the United States. In conclusion, America's $1 trillion credit card debt crisis is a complex problem with no easy solution. However, by understanding the root causes, implementing responsible practices, and providing support and resources to those in debt, we can make significant strides toward alleviating this crisis. It's imperative that individuals, financial institutions, and policymakers take action to ensure that credit cards are used as tools for financial convenience rather than sources of financial hardship. Ultimately, achieving financial stability and security should be a collective goal, and addressing the credit card debt crisis is a crucial step in that direction.